All right, so after a 3-hour road trip to our high school basketball game tonight that I helped coach, I coached the JV team. 3 hours one way, so 3 hours back after we played the game. So 6 hours on the road today to be able to and obviously there for multiple games, three different games and at the same time. So that's why the video's out really late today, but. I'm home and was able to get this done here before I go to bed. But we did break down today's move in the S&P 500. I talk about how much follow through there was from yesterday from this previous bullishness that we've had. Are we did we have the breakout, right? Did we have enough now to be bullish, to be able to be bullish for a while now, to kind of regain this bullish edge? So we'll take a look at what the indicators tell us and then look for a trade idea in a stock that did quite the opposite from what the S&P did, and talk about how to trade that. So let's go ahead and get started. Today is Wednesday, January the 12th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at how we finished the day today. You can see almost back up to that 23. In fact, a little blip above that 23% retracement level. Remember, getting back above this level is back to bullish trend, right? So that's a really good thing. Now, granted, today's range really dropped down. So after a couple bigger than average ranges, which is what you'd expect to see when you're below the moving average, right? Now we're back above the moving average, and just like that, before we get back to this trend, we're back to a small average range. So let's see if how that holds up tomorrow. You'd like to still see bigger ranges until you get really solidly set in the new trend. The intermediate line did stay in the bullish area here, turn back up, so you got dark green shading and green line again. The near term line got back above the 90th percentile, very good bullish move from that perspective, right? Getting above the 90th percentile is a strong bullish run. You can see this would be a higher low point than this last one, that we had over here. If you can kind of consider this all one big near-term low point, I know there's a little brief rally here, but if you kind of consider that one big low, this would be a higher near-term low. In fact, we've got a couple of higher near-term lows in a row, and like I said, back to dark green shading. So a good sign. We're only 1% above the moving average, so we're not like we're breaking out here, but you can kind of see where we're not that far away from what would be a breakout if we were to continue to move this higher. If you take a look at the NASDAQ, though, a little different story. We're just barely above the 38%. We're still below the moving average. We're not anywhere near the 23% retracement. The near-term line did get above the 90th percentile, so a good sign there. But the intermediate line is actually still in bearish territory, so we're not quite out of the woods yet on these indicators. Same thing with the Russell 2000. The Russell 2000 actually dropped today and actually dropped back down below this 23% retracement to stay bearish. For the end the bullish retracement and to re-engage on a new bearish move. Intermediate line is still in bearish territory, slightly above its moving average, but not very much. And again, the near-term line not above the 90th percentile. In fact, it's barely in bullish territory and would be a really bearish near-term peak if this is all we end up getting. So definitely not out of the woods when you look at the NASDAQ and the Russell 2000. It's really the Dow Jones that's been the most bullish. Here's the Dow Jones Industrial Average. It is back above that 23% retracement as well, just like the S&P. The near-term line did not get in the upper reversal zone, did not get above the 90th percentile, so not as strongly bullish there as we saw on the S&P 500. When you take a look at the S&P on this chart, again, we're kind of flirting with red arrow territory with this bearish Hakinashi candle, so keep that in mind. The NASDAQ already has the red arrow on there with a bearish candle today, or this week, excuse me. And the Russell 2000, remember, as Hakinashi closes actually below the 40-week exponential, falling PPO, falling negative differential. So nothing's changed in that regard. From a 3 green arrow standpoint, you can see you do have, we're not light pink shading anymore on any of these indicators. The only one that we're still light pink shading on is the Russell 2000, because remember, it was down today. So it's still stochastic, still dropping. The the green arrow on the Qs, we actually got a green arrow on the stochastics, and that's what keeps it from being light pink. And we got 2 green arrows on the on the S&P 500. You can see the S&P is back above its 17-day moving average, so a good sign there. Set up for what could be a new bullish divergence, right? Again, if we were to get back up above these areas and get that intermediate, that MACD back above its moving average as well. If you take a look at, again, some of the other indicators though, and you can see the Qs have not gotten back above, and remember, a very small range, much smaller than average, smaller volume than what we saw last couple of days too, below average on the volume. So, we're not even in bearish convergence mode. MACD is still below 0 and below its moving average, and we're still below the 17 days. So we're still actually in bearish divergence. You look at IWM and it's even worse, right? We drop back down below the 8-day. The 8 and 17 are crossing down below the 30. The stochastics is dropping into bearish territory. The MACD is still in bearish divergence mode there too, after failing at the 17-day moving average at the high of the day today. And we're close. We're still below the point of control, and we're close to a death cross on the Russell. So relatively bearish candles there. Looking at some of these other oscillators, here's the S&P 500. You can see the Russell too. They're kind of the same. Not really too strongly bearish, but also not really strongly bullish either. Here's the NASDAQ 100. All looks very similar there. From the directional movement index, the negative indicator is still well above 25 on the SPY. It's also well above 25. It's above 30 on the Qs, and it's kind of flirting with 25, but still above it on IWM too. So getting above 25 is significant, and either one of these to be trending, and they're all up above 25 for the negative indicator. So like I said, not out of the woods hardly at all. The S&P 500 is back above its green line. Still no trend down there at the bottom. The Q is very noisy, have been very noisy for a while, inside of the cloud there. And then IWM is below the cloud, and it's back below the blue line and green line. Again, no trend, still pretty noisy here, so we don't have but you can kind of see, man, we are really poised on IWM, sitting near that 23% retracement. And remember, there's this no volume down below that level. Here's the 2-year. I mean, there's the very, very little volume down below that level, so very easy for it to fall all the way down to this 170 level if that ends up being the case. For SPY, you can see we're still above the value area on the 2-year chart, flirting with the top of the value area on the 1-year chart, and still right smack dab in the middle of the range. There's the Qs in the lower half of its range, and IWM also in the lower half, kind of flirting more with the lower quartile of that range there, and below the point of control, as was mentioned before. Let's take a look at the intraday chart there. You can see we gapped up, but filled in that gap earlier today, and got a higher high and a higher low, closed above yesterday's high. We're above last week's low point, so bullish candle there. Higher high and a higher low on IWM, but we filled in the gap, but we stayed below yesterday's high point, but still in the lower half of the 4-week range. So still relative, not nearly as bullish on IWM. And the Qs, we did finish up above yesterday's high and the 4-week point of control, and right smack dab in the middle of the 4-week range. So we'll see if we continue this to the upside tomorrow, or if this ends up being our peak there. So let's take a look at volatility and see how that dropped today. You can see down to below that 82.5%. Still in the really, really bullish territory. Again, not extremely oversold, not below 80%, but pretty darn close. Very low for volatility, relatively speaking, especially when in the past we've seen the skew be so high. Here's the highest and lows, which has now pretty much gotten back close to 0, though the average is 225, minus 225 here. Here we go. There's the moving average, so it's a pretty low average there, but getting back near to 0 on that level. And if you take a look at the skew index, We are pretty low. We're much lower than we were. Bringing that average down typically occurs on declines, so we haven't had much of a decline yet to bring that average down. And the average is still high. It's just barely dropping below 145. And then when you look at like the trend, you can see it's been really low too, which means we're not getting a lot of declining volume relative to the number of decliners that are out there. The ratio is very similar when you look at advanced decliner versus advancing volume, declining volume. So in fact, you can argue there's actually a little bit more advancing volume than there is declining volume, and that's why we're getting such a low number that's been progressively lower. The MACD for the trend is the PPO is very, very low on that indicator. So the VIX is oversold, poised to rally, and if you look at the VIX on this chart here, we are back below today that 200-day moving average. So big move. You know, if we were to hold this and stay down below that 200, it'd be a very good sign for the broader markets, and especially if it coincides with the S&P getting back above that 23% retracement and holding above that. So the markets kind of have bounced back. You know, we lost some momentum from the last couple of days today with a very small range and low volume. The question is whether we can regain that momentum with kind of a breakout move tomorrow, or was today's move an anomaly. So we're going to test that out in tomorrow's indicator. It appears from the near-term line on the market forecast that we're probably leaning more towards regaining the momentum from yesterday and continuing higher with that strong near-term rally. The problem is what we're seeing on the NASDAQ and the IWM doesn't necessarily confirm that yet. So we need to see, in my opinion, we need to see some more strength from these other indexes to support what we're starting to see, or what we may be leaning towards on the S&P 500, to be able to get, especially considering they're in multiple areas of the market, to be able to confirm each other and really solidify the new bullish sentiment. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're either a lot more bullish than I am or a lot more bearish than I am? All right, before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us you liked our video today and that you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments you have about anything that I brought up? Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right. Click on this icon. I told you I taught about the Market Outlook trade I did later in the video. I already did it earlier today during the Market Outlook Live. This is where I do that. Click on this image. It takes you to this Market Outlook Live page. You can also come up here, click on Market Outlook Live Trade Review. This is where I put on the trade idea before you get it here in this video, before the market closes. I also take a look at all the old trades that we have done in previous videos to see whether we should stay in them, get out of them. That's all done in these. Here's all the archives as well. You can also see our upcoming classes over here on the right. Click on View More. That takes you to our full calendar. You can see the rest of the month. You can see all the recordings going back 3.5 years here. You can just go back to prior months, search in whichever month you want there. Come down here to the bottom, click on that heart. It opens up this new tab. Hit that like button. Also click on this thumbs up icon. Opens up this tab. Hit that like button. Again, the more you do that, the more people will get our content, because the more engagements, right, they have, whether it's likes, comments, shares, the more you do that, it really helps us get our content out to all of our stuff. So that's why we always ask. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's talk about what's driving the price action today. Look at that big move that we had in the emerging markets. Big standout move, well above what we saw with the S&P and the Qs, and of course IWM with a loss. But look at that big drop in the dollar. That's a dramatic reversal in the dollar here. If you take a look at the at UUP, let's actually look at Euro US dollar here, which makes up 60% of UUP. And look at that run. So that blue line that you see down there is a multi-year trend line coming down all these highs over the past 15 years. So we broke up above it. We've come down now and have tested it. And now, as you see that MACD and stochastic start to move over to the upside, if you take a look at, let's go back here. If you take a look at the euro, look at this breakout move. We've been converging, basing, trading between the 30 and the 50-day moving average here, with the 8 above the 17-day, the MACD positive, and then today breakout city. That was a big move. Yesterday we got above the 50, but today's move is big time breakout, breaking above the 50 and working its way towards the 200-day moving average. That's on the daily chart. When you look at the weekly chart, now granted the week's not over with, and you can see the MACD is above its moving average, still below zero, but above its moving average. That's how close we are to getting back above the 17-week, which would be a significant shift towards a bullish divergent on this chart. So the biggest impact that had, the weakness in the dollar, was on emerging markets. 2 days in a row now, emerging markets just breaking up sharply. That's a dramatic reversal as well, getting above the 50-day moving average, working its way back up to the 200-day moving average. And when you look at the weekly chart, again, same thing. The MACD has been below zero, but it's crossing above its moving average, and you are above the 17-week exponential moving average here, and working your way to the upside there too. So there's an opportunity now for IWM after consolidating this entire time, pretty much down to the 38% retracement level of this post-COVID move. Now appears to have found support at that 38% retracement, and then potentially is getting not only back above its 17-day moving average, as you can see here. Let me get rid of this line for so we'll leave that black line on for a second, but you can see this orange line right there. There's a 23% retracement right above the 30-week moving average. Now the black line is this current intermediate run that we had at the end of 2020 going into the beginning of 2021. Kind of like it after this little consolidation move, after the first initial post-COVID surge, and then a consolidation, and then the second surge. We hit the 62% retracement of that rally and found some support. So multiple Fibonacci levels in this area, and like I said, getting back above the 17-week is a very strong sign. We go from bullish convergence to this bearish divergence, where we really broke down and continued down, and then now with the potential breakout, it's a very, very good sign. And again, all coming from stemming from the weakness in the dollar, still pushing up on commodity prices. Commodity prices almost getting back to the post 2000 and the mid 2014 highs that we hit right before the dollar took off. So big rally in commodity prices, over 100%, or close to 100%, and now to the top of the 10-year. Was this a 10-year chart? Yeah, so the 10-year value area, and you can see a very strong bullish pattern on a weekly chart, and a very strong pattern again on the daily chart, with the 30-day moving average close to breaking back up above the 50 and trending higher. This inflation expectations really likes, commodities like rising inflation expectations. The yield having peaked here and looking like it's moving back to its moving average. Remember, that's the IEF. IEF is so far down below its 200-day moving average, and is just moving its way back to the 8, maybe the 17. So that's probably all we're going to get in terms of strength in IEF as yields continue to price in Fed policy decisions. And again, if we break above the 17, that's a different story, but we got to do that, right? And as of right now, we're not necessarily doing that. The weakness in the dollar was a nice benefit for gold. over the last couple of days. It's trying to break out, but it's been so sideways, and you can even see like the Bollinger Bands for gold are very small, relatively speaking, especially when you look at it on a long-term chart here. Very small, relatively speaking. So it's setting up for some kind of breakout, either a breakout to back above the 23% line to the upside. Let me get rid of this for a second and make it easier to see. So break back above that 23% and really start a new trend to the upside after holding the 38%, or break out below the 38% and any layer of support we have and work our way, fall from a volume level and work our way back down towards these other Fibonacci areas down on the bottom. So my opinion is, especially considering the weakness in the dollar, is we'll probably end up breaking out to the upside. Bitcoin has been discussed as an inflation hedge, and you can see it's still struggling, right? Really struggling to get going here. Still very bearish, still in a death cross. 30-day now is crossing down below. He did rally the last couple of days, but only to the 8-day moving average and nothing more than that. So, and all these averages are still falling. We're still easily below the 17-day, so we're at best in a bullish convergence mode, or bearish convergence mode right now, with significant resistance up above. So Bitcoin is not necessarily that extreme risk-taking, risk sentiment trade, still not really taken back off again. Let's take a look at how the sectors performed here today. Look at the comparison chart here. Remember, a big drop in the dollar, big bullish move for emerging markets. And you can see that the outlier was XLB, material stocks, to the upside. Discretionary technology did well for most of the day. On the other end of the spectrum, financials and energy, remember, they've been very strongly bullish, giving back some of those gains. Staples also pulling back, and healthcare has also been relatively strong lately and giving back some of its gains as well. But otherwise, pretty flat. Those were all really small numbers, especially compared to prior ranges. It seems like we were all trading below average in the range department. XLK, XLY, XLC, flirting with those moving averages. Energy and financial still very high above theirs moving averages, and everything else having pulled back from a sector standpoint. And you can also see too from a global market standpoint, China really breaking out, Japan breaking out, India taking off to new highs. Look at the breakouts in Canada and Brazil. We talked about UK getting that cluster. All of these international markets, except for Russia, all these other international markets showing very strong breakout patterns here. Good sign for that segment of the market that's been underperforming during the strength in the dollar. There's the dollar, there's the oversold cluster, very big drop in the dollar there, and you can see some of the other asset classes that are relatively bullish. Copper had a good run, breakout pattern yesterday. That's a good sign from an economic growth expectations. You can see the move in EM and EFA, and even silver is looking much better than normal, even if some of these other safety trades or precious metals, aren't doing nearly as bullish there. All right, so for our trade idea, I wanted to take a look at Lyft. Lyft is even more bearish. But we looked at this kind of in the middle of the day when I did the Market Outlook Live today. I remember I used that link that popped out to check here at the beginning of this segment to go to that Market Outlook Live page where you can see the trade idea posted before the market closes on the day I do the Market Outlook videos. So we've already done this. I did it a little earlier than normal. Typically we do it at 3:30 Eastern Time. I did it at 1 Eastern Time today because I had to get out of town for a road trip. But you can see like it even kept going down even more after we got into it. And the intermediate line turned down, the short-term sentiment line turned down out of bullish territory, very bearish near-term peak from that perspective. When you take a look at it, long-term chart, we are in a death cross environment. We retested the 50. It looks like it's trying to turn, to at least transition from this brief bullish run that we've been on. Taking a look at the MACD, the two-line versions here of this chart. You can see back below the 17-day moving average after failing at the 50. MACD back below its moving average, stochastics dropping. So looking like we're below the value area. In fact, you can see here, well below the value area, and getting back into the lower half of the chart after a few weeks up above. So very strong move to the downside today, back below that green line, easily below the cloud, failing to get back above it. Kind of in a noisy pattern right now. The directional movement index, where the positive never really got above 25 on this rally, and the negative has been below 20, is trying to reverse course, get back to the upside. And then finally the RSI and the CCI, you can see breaking back down to bearish levels again. So a pretty significant bearish move on lift has led me to do a bearish trade on it. So what we decided to do was to sell the 45 call option and buy the $5 wide, and we ended up getting in on it. Let's see, how much did we get in on? Trade by 82 cents. So right now you're looking at about 70 cents of credit by the time you get into it. So we're already doing pretty well just since the close of the market today. As lift continued to trade down, you'd expect that it would, considering where we're at. And then of course we're willing to lose $410. So we're risking less than a normal position size to get it. So that'd be $410 would be about half of what we could lose maximum if we close out. It doesn't always work out that way, but it happens to here. So it happens to be a really good setup for a short call vertical spread. Remember, if we hit 50% of maximum gain in the next 17 days, so before we drop into the 20-day window before expiration, or after, until expiration, if we can get 50% of maximum gain before then we'll take it. Right, we'll take advantage of the bearish moves that are quick, wrap up, get that credit, and then move on and try to get the 50% of the rest of the max gain, or get a full max gain using that same capital somewhere else on another stock. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have, or apply to anybody else's thread. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Remember, you can also subscribe to our website for free. Like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, Thursday morning, everybody. And we'll see everybody next time.